All right, continuing to watch the stock market now, really coming way back from where it was at the open today, over 1,000 points down at the open of the market. Right now, clawing its way back, only 117 points, which is less than 1%. We're going to continue to obviously monitor the market as we get closer to the close, but we want to bring in Keith Fitzgerald. He's the Chief Investment Strategist at Money Map Press. Keith, thanks for joining us.
My pleasure to be here. Thanks for having me.
So we've seen the market sort of pulling back from where it was at 9:30 this morning. One person described it to us as a very, very scary open. What do you make of the recent activity?
Well, here's the thing. If you're a long-term investor and you have perspective, you take emotion out of the picture, what you really are left with is a very simple equation. Moves like this are based on short-term market gyrations that have little or nothing to do with the longer-term business case. So what you saw literally this morning was a lot of Friday's angst bleeding into Monday morning's openings, and then you saw buyers come in because they're looking at companies like Apple, they're looking at Google, they're looking at Netflix, they're looking at a lot of places, Gilead, for example, and saying, you know what, this is a realistic value, and I'm going to do just fine if I wade in right here.
So, Keith, based on what you just said, what do you think the rest of the week looks like here?
You know, it's too early to tell, but bounces like this typically have a little excess volatility. They're like a guitar string. You pluck it, it's going to continue to resonate for a little while. I'm not going to be surprised if we come back in and test these lows in the next few days. But again, that's more of an opportunity from my perspective than it is a risk.
Yeah, Keith, a lot of people are going to be looking to overnight numbers, what we're going to see from China in the overnight. And could perhaps the fact that, at least where we are right now, 12:39 in the afternoon Eastern time, could it mean that other markets who were spooked by what they saw in the emerging markets, take some heart with what is happening in the U.S., and a country where the fundamentals are still strong, where the fundamentals of those companies within the market are strong?
I think that's a very sharp observation. I think what they're going to want to see overnight is two things. I think they're going to want to see some measure of control or support from the Chinese government. Absent that, I think there's going to be a little bit more blowback in the morning. But clearly, the United States is the player in the global markets, and we will set the tone for the next 24, 48, 72 hours.
What does it tell you, Keith, that a company like Apple, which was down, is now back in the green here? You know, obviously for a lot of people, this kind of gyration is nerve-wracking. And individual investors will look at that, some people, and decide that they need to take action immediately. What does it tell you when a company like Apple is now doing so much better now?
Well, again, you know, you've hit the nail on the head. The individual investor will say, oh, my goodness, I've got to do something right now. But really, Apple is a long cycle game. They're a technology company that is clearly got the potential to change the world. There is value yet that has not been recognized in that stock. And the way you tap into that is by investing in the strongest companies, those with the best balance sheets, those with the best sales and the best perspective. And that's a company like Apple. So to me, again, if you bleed out the excess, you scare out the weak money, that's an opportunity for an individual investor, and one of the very few points where an individual can get ahead of an institution, because you don't have to keep your money moving. You can, in fact, you can afford to sit back and let it grow.
Keith, are there any particular sectors of the market, given that we did see some lows today, are there any sectors that investors, if the smart investors can say, well, look, I still love technology, I like that market or that sector, but maybe I need to pull back a little, for example, in energy because the price of oil has been knocked down so much, or maybe I need to look a little closer at manufacturing. Are there any sectors that you like and some that you think maybe, yeah, let's move some money out of that into something else?
Well, I think, you know, if you're like most investors, then you're going to have some bonds that have done very, very well today and in the last 30 days or so. To me, the logical opportunities right now are going to be big defense, so names like Raytheon, for example, which is a classic defense play. Some of the technology, Apple, Google, Netflix, those are all interesting and compelling at this point in time. But don't forget healthcare, because Obamonomics is still very much a real factor. A lot of the insurance companies are doing just fine, and there's going to be increased demand for anything that they're serving up. So a company like Becton Dickinson, for example.
Keith, let me ask you this. Taking a step back and looking at the big picture here, with so much talk of China in recent years and the growth that has been happening there, now what we are seeing, as you and others have pointed out, result of what's been happening there in China recently, is this a reason to have investors really take a step back and pause before they think about looking at China in the long term? Because for so many years, it seemed, China was this engine that was driving a lot of the economy.
Well, it certainly has. You know, I've spent 25 or 30 years over in the Asian markets. In particular, I live in Japan part-time, so I'm very connected with that part of the world. I think that the one thing that the Chinese bears have continually been wrong about for the last 40 years is the fact that China is going to go away. It may slow down, it may have its speed bumps or whatever, but you're talking about the greatest consumer capitalist engine that has ever been created. The stock markets are still in an infantile state. One of the reasons why we have such problems with China right now is that the Chinese government is trying to control what is essentially a free market activity. If you separate those two things, there are still going to be companies, most of them based right here in the United States, that are going to do very well in China over the next 3, 5, even 10 years.
And Keith, you know, there's one thing, though, that we haven't really talked about in our discussion, which I think a lot of investors are looking at, as well as traders, which is what will the Fed do in September? There had been a lot of talk that the Fed's thinking about perhaps raising interest rates. They'd been so low for so long. Given the volatility that we've seen, given the volatility in the emerging markets, is that still perhaps the plan in your analysis?
You know, the Fed has so horribly mismanaged this from the very beginning. They missed the crisis in formation. They missed the recovery. They've still got a problem with rates. I think that academically they're going to want to raise rates. I think realistically now what you're seeing with all of this crash, with China's melting down, in fact, you've got deflationary influences. So I think we're looking at January of next year at the earliest.
And real quick, Keith, you know, we talked about the fact that China there's 1 billion people there. They're going to continue to consume. They're going to continue to gobble up oil. I mean, they are importing natural resources left, right, and center. But how is this, what we're seeing in China now, different perhaps than what we saw back in 1997? You saying that you spent a lot of time in Asia. What was the difference then with that Asian flu, as they called it?
Well, the Asian flu back then didn't have the consumer backing that it does now. People are talking about China as the exporting engine, and they're right. It's a huge component of the global manufacturing process. But what they're also forgetting is that China imports 98, 99 cents on the dollar. So if we want our markets to succeed and we don't want the blowback to hit here, we better hope that theirs succeed. So there's a vested interest. We need them as much as they need us. And that, I think, is a good key takeaway and one that speaks to strength over the next 3 to 5 years, not weakness.
Important insight. All right, Keith Fitzgerald, thank you so much.
My pleasure.